Good afternoon, everyone. Welcome to Officer 24/7. My name is Niharika Walia Bhatnagar, and I'm with you with the area of CAIIB ABFM. So, good evening, everyone. Oh, it's actually afternoon. So, good afternoon, everyone. Let me know if I'm audible as well as clearly visible. Acha, as in our previous case, I couldn't share the portion of the module C with you. I couldn't start with that particular point, so I'm starting it with right now. Good afternoon. Acha, along with this, one more point, I have shared the module A, B as well as D on the Telegram channel. If you haven't joined the Telegram channel, join it right now and get the particular PDFs. Now, when we talk about this particular topic, module C there, module B and module C are super important from the point of view of the fact that in the examination last year as well, that is the last attempt, they had given more questions from module B and C rather than from the area of A and D. So it's very important that we are sorted about this scenario, that yes, which particular portion of the book is more important for us. Right? Okay. So everybody, let's begin with the session. But before I begin and before we continue further, there are a few things that I would want. Please go ahead and like the session. Please go ahead and share the session, and at the same time, if you haven't joined our YouTube channel yet, then go ahead and subscribe the channel as well. A few important things. Now let's begin with the area of ABFM. A gentle reminder, we have our ABFM bilingual marathon starting at 6 p.m. Definitely go ahead and join it up again, because your marathons are compiled by the best faculty. They are working upon it round the clock, and we would look forward towards the cooperation as well as appreciation from your side too. Okay, so let's begin with it. Please go ahead and share the session, everyone. Okay, starting with the first chapter, corporate valuation. According to me, it's an important chapter for this examination. So let's begin with the first question. In this particular area, I have covered both. That means we are not only covering the numericals, but we are also covering the theoretical portion of the numerical part as well. Okay, starting with the first question, it says, what does the enterprise value? Enterprise value is given in the beginning of the corporate valuation itself. Represent in the corporate valuation the total value derived from the analysis of market capitalization, the total value of the company including debts and other obligations, the book value of the company as established by its financial, I think it got there, financial era, and the last one is the equity value determined by outstanding share multiplied by the share price. Now if I look at the enterprise value includes your equity. There is a voice mismatch. Anybody else having the voice mismatch issue? Please let me know. Just a moment. Just a moment, everyone. Fixing it up. Done, everyone? Is it all sorted now? Chaliye, let's continue further. Waiting for the confirmation. Now let's talk about enterprise value. When we talk about the enterprise value, it can be stated as, thank you sir. When we talk about the enterprise value is stated on the basis of whatever the share capital of the company is, the reserves and surplus, every part of the equity is taken along with the long term debts, that is the ones which are having interest. right? But you deduct cash out of it. Remember this part, that you deduct cash out of it. So the correct answer is B, total value of the company including the debts and other obligations. But if you have to give the proper detailed formula na, then you have to remove one thing out of it. You have to reduce the cash and cash equivalence out of it. This is the formula. Okay? Done, everyone? Please keep on sharing the session and don't forget to like it, everyone. Next point. Next point says, what is the primary focus of market approach in the corporate valuation? Determining the value based on recent transactions or comparable assets, estimating the worth of the business by comparing it to a similar businesses sold recently, evaluating the present and current value of the expected future earnings or cash flows, or extracting value by combining the fair market value of the net assets. Now, when we're talking about the market value approach, we are actually trying to find out what is our value in the market right now. है ना? So, we'll have to see what is the value of the organization in the market. So, in this case, what would be the answer? Go ahead and answer, everyone. Correct, sir. It is A. Okay, determining the value on the recent transactions or the comparable assets. Matlab, we are going to compare, if I am thinking my value is 10 in the market, then it should be based upon the similar organizations or the recent sale that I would have made. Done? Next question. Which valuation approach is particularly helpful for asset-intensive businesses, holding corporations and troubled entities? When we talk about what valuation approach is required for asset-intensive businesses, they have a lot of assets and they have holding corporations, matlab one particular organization holding the other, and then we have troubled entities. Is it market approach, income approach, cost approach, or we have a direct comparison approach? You just can't compare these kind of companies with anything else because they have a very negative image in the market. When you have a negative image in the market or you are going through losses, then the organization cannot be compared with any other, right? So in this case, what will they do? In this case, when we talk about the question, Dev sir, according to you, it's D. So direct comparison talks about one particular company compared to a company which is of its similar kind. Okay. So that is something we define in terms of direct comparison. Market approach is based upon whatever your market value is. When we talk about the businesses which are troubled entities, now they're already having problems, right? So yes, in this case, we will have to go for cost approach. Ki whatever the cost of the things are there in the market, ki whatever their assets are, value their assets at their historical cost. The safest option, book value. Always remember, the moment people will see that the organization's value is getting negative, then what will happen? This organization will lose its charm in the market, which is definitely not good for them. You know? Done? Achha, everyone, please keep on sharing the session. This is an extension of the yesterday's class itself, but since we are just covering the module C, so that's why I named that module C only, and this would be covering only and only the module C portion. Next question, everyone. Done? Chale. Now let's look at how can current replacement cost be used to modify the book value of the assets. Current replacement cost. Pata hai, when we talk about the current replacement cost, this particular cost doesn't come into the work at all. In terms of the current replacement cost, we will say that in terms of the costing would be taken in terms of current only and only when we have an organization which is dying. Always remember, if there is liquidating, at that point of time, we do not have any other option. At that point of time, since the company is dying, you need to know the realistic value of that particular organization, isn't it? So in this case, what will happen is, how can a current replacement cost used to modify? The replacement cost is subtracted from the book value. The replacement cost is added to the book value. The replacement cost is used to place in place of the net book value or replacement cost is ignored. When the company is dying, at the time of liquidation, everyone, we cannot take that particular risk. We cannot take that particular risk that the organization can record things on the basis of the historical cost. For example, I bought something at rupees 10 and that too 1980s. At that point of time, rupees 10 was such a huge amount. Right now, it's not that huge amount. So in this case, can we say when we talk about this kind of thing, in this case, you will replace your cost with something else. The replacement cost is used in place of the net book value. The correct answer is C. Moving on to the next question. Why might the book value of an asset become increasingly disconnected from the actual value or as a result of inflation? Now they're talking about this particular amount. Why does it change so much? Now the point is the book value considers inflation in its calculation. The book value normally doesn't include it. The book values will always record things at the cost at which we have bought it. So that means it is not considering the portion of the era of changing in values. For example, I bought a piece of land in 1980s. It costed me 10,000 rupees at that point of time. Right now, the value of that asset would be in crores. So initially, if you're not going through any major changes in your business, you will record those things at the value at which we have purchased it. The historical cost of the asset is not subtracted from the depreciation. Depreciation is not considered in the book value calculation. Book value does not take into account the inflation. Book value just doesn't record anything in it because book value is the value at which you have bought it at that point of time. So in this case, the correct answer is D. Book value does not take into consideration the inflation portion. Okay? Done, everyone? Please keep on sharing the session, and if you have just joined, go ahead and like it as well, everyone. Okay, the answer is D. That is, you will record the book value. Once the book value is recorded, the inflation is never recorded at that point of time. Next point, what is the primary shortcoming of the liquidation value approach? It does not consider organizational capital. It relies heavily on the secondary markets. It overvalues the tangible fixed assets, or it focuses too much on the going valuation. What is the primary shortcoming of liquidation value? But the liquidation values are found out when the organizations are under stress or their future is in jeopardy. That means the organization is having a problem that you never know whether it would survive through this particular period or not. So that's why the major issue with the liquidation value is positive point first. It includes the present value of the things. You know at what price we'll be buying or selling it, right? Now, what does it say? It relies heavily on secondary market? No, it doesn't. Then it overvalues? No, it cannot do this part. There is one part which it has to actually neglect totally. There is the organizational capital. What do you mean by organizational capital? This doesn't mean the organization's equity and all. It is the people who are investing in the business. That is your worth in the eyes of your supplier, your worth in the eyes of your employees, or your worth in the eyes of all the people who are the stakeholders, right? So that part is organizational capital, though now it is still considered into the area. Earlier it was not even considered because it was said that this cannot be taken into the form of cost there. Okay? So it does not consider the organizational capital. Next point, when we talk about this area, what may be the disadvantage for companies with medium to heavy borrowing? If they have taken a lot of borrowings, what will happen? They will have low interest rate, better credit rating, hindrance in decision making, or higher profits. Whenever such companies are taking decisions now, what will happen? Whenever you are trying to take a decision, your nominee director, the director which has been appointed by the debenture holders of the company, the persons who have been appointed by any other people who are involved in our business, they will create a hindrance and they will say you cannot use our money for so and so purposes. So what they define is they have restrictions. So hindrance in decision making comes out of this. The information mentioned in this area, they are saying that borrowings are rated at a few notches below this no or low borrowings, which may hinder the management decision making process. Whenever you have bigger losses, then there is a lot of interference from other people in terms of your decision making. Okay. Now here comes the next question, that is, how is the value of land determined? In the context of tangible fixed assets based on the cost of replacement as if it were uninhabited and on the market by calculating the market price of the comparable assets or subtracting physical depreciation from the cost of replacement. Okay, to the point, one more important point that exists there is, in case of cost, you will never see depreciation in case of land. Land does not depreciate, everyone. Okay? Done, everyone? Then what is it? Based on the cost of replacement, land cannot be replaced. It is already a particular thing which is already that is something which is already scarce in nature. It's something that you just can't replace at all. So technically this one's also wrong. By calculating the market price, the comparable assets are normally seen, this is saying in terms of the properties, real estates. Yes, it is done. But in this case, the better idea is to take as if this land was uninhabited and is on the market, and what is the price that is coming out of it. So yes, the correct answer is actually B. I think similar question or the same question was also given in our IIBF book as well. Okay? Oh. What principle is the direct comparison approach founded on? Principle of equity, proximity, substitution, or continuity? When we talk about this area, we are talking about principle direct comparison. That means you are comparing your company with some other company. When such a comparison is being done, there is only one rule. You will see that what if I put this thing instead of that? That means you are going to talk about principle of substitution. The answer is C, principle of substitution. Next question. What is crucial for direct comparison approach to work effectively? Complex attributes for accurate comparison, maximum tweaking of comparable value, comparable businesses with minimal tweaking, or a diverse set of comparable businesses. Always remember, no two businesses are absolutely same. They can never be identical. Even the businesses which were similar in terms of the startup lines, they change over the period of time. So you just cannot say that in terms of direct comparison approach, you will see that this is identical in nature. So what we see that most probably there might be a little difference, but not major. That means there should be minimal tweaking. Okay? And you should be able to compare them without any hustle bustle. That is the point here. Now comes the next question. Achha, this is a question related to the area of WACC, weighted average cost of capital, according to me, is a very important topic to be covered for the examination. Can be asked in the examination in the form of practical as well as theory question. In terms of theory question, they can give the items of the WACC to you and what is the importance or whatever those items are. They can ask questions related to that as well. So when we talk about WACC, what is WACC? WACC is known as weighted average cost of capital. What's the formula for it? The formula is cost of equity into weight of equity, cost of debt into the weight of debt, then cost of preference shares into the weight of preference shares. So we do this. Okay? So in this case, ABC Corp is considering a new project with an initial cost of 15 lakh. Matlab they know they have to incur a cost around 15 lakhs. The company plans to finance the project with 50% equity and 50% debt. That means 7 lakh 50 of it would be equity, 7 lakh 50 would be of debt. That's sorted. The cost of equity is 12% and the cost of debt is 6%. So how do we calculate the WACC in this case? There's no preference shares, but we know the portion of equity is 50% and the portion of debt is 50%. So you know their weights and then multiply the weights with their costs. The cost of equity was 12% and the cost of debt was 6%. I'm sorry. Everybody, what would be the answer in this case? Quickly answer. If you have just joined, please go ahead and share the session and like it as well. What would be the answer? It would be this is actually 6% plus 3%. It comes out to be 9%. The answer is 9%. Correct, Dev sir? Chandramukhi ma'am? I hope you have seen the particular PDF of the class as well, everyone. In the last class, there were certain things that I couldn't discuss it with you, and I've given it in our PDF itself. So you can review from the PDF. The numericals and their answers, everything is given there. Okay. Now let's come to the next chapter. The next chapter is discounted cash flow valuation. When we talk about the discounted cash flow valuation in context with discounted cash flow valuation, when we talk about the dividend discount model, what is the primary difference between FCFE and dividend discount model? What is the major difference, everyone? Yes, Aman sir. I think in the last one, if I go back, it is 12% and 6%. Na? 6 plus 3, it has to be 9. No, the answer is given in a wrong manner. The answer is 9%. It is not C. It is actually A. Both of them are taken at 50-50%. 50% of 12 has to be taken and 50% of 6 has to be taken. 50% is 6 and 50% is 3. And there is no preference shares at all. So there is no weight or something. So in this case, the answer should be 9. The answer given is wrong there. Okay? Now comes discounted cash flow. We were talking about this. DDM uses free cash flow method. Then DDM uses dividend discount model, considers cash flow to all claim holders, while FCFE. Acha, now this is actually a truth point. Let me give you the answer directly. FCFE is free cash flow for equity. One is FCF, free cash flow for the firm. And when we talk about discounted cash flow model, DCF. DCF talks about dividend discount model, which is specifically for the dividends which are received. That means overall dividends. And when we talk about FCFE, this is the portion of the cash flows which are there for equity shareholders. So technically, na, the answer is B only. DDM considers all the claim holders. First of all, everybody else is paid. Whatever is left is given to the equity shareholders. So in that case, the answer is B. B talks about the cash flows of all the people, while FCFE is exclusively linked with equity. What is one of the challenges associated with the using of management estimates or consensus estimates for the growth in discounted cash flow valuation? Management estimates are always accurate and unbiased. This doesn't happen. Consensus estimates are too conservative and underestimate growth. The next point is related to the area of both management and consensus estimate may be biased and lack of objectivity. Analysts should solely rely on surveys to obtain growth. When we talk about management and consensus, in this case management, what are we doing? We are leaving it on the management to do the decision making. Or when we talk about the consensus, where everybody is talking and participating, in this case the correct answer is going to be both. Both of these can be wrong. There cannot be a situation I could say that only the management can be biased and the consensus case cannot be biased. Both of these things can happen. Okay? Next point, which factor is more likely to contribute to sustained growth for an extended period? Which factor, everyone? General sources of growth, competitive advantage like well-known brand name, or management competence or first mover advantage? Due to first mover advantage, you get extraordinary profits. But always remember, if you have a strong brand name, companies like Nokia is gone now. Let's talk about Nike. Nike is some organization which has survived in the worst case scenarios. Nike is such a strong organization. So when we talk about such organizations coming up and gaining so much, how are they able to do this? They are able to do this because they created their own strong, well-known brand name. Then the answer is B. Competitive advantages like well-known brand name. Which discounted cash flow model discounts the unlevered equity cash flow at the unlevered cost of equity and adds the discounted cash flow value of the interest, tax shield on debt. EV, enterprise discounted value takes it, or we have equity discount model, adjusted present value, or dividend discount model. Which takes the unlevered first and then takes the levered part later on? We are actually adjusting this portion, everyone. We are taking adjusted portion, right? How? First of all, you take everything which is unlevered. Unlevered means there is no impact of loan taken. And then when we take the part of the loan, how do we do it? We take the part of the loan and then we adjust it accordingly. So the answer is APV. Okay? The answer is APV, adjusted present value. Now comes the next question. This question is related to the area of dividend discount model. I think I should have written it in a proper way. In this case, they are saying that XYZ is expected to pay the dividend of 3 1 year from now. That means we are given that D1 is 3 rupees. Then we have the dividend payment are expected to grow. The growth is of 5%. Then if the investor needs 12% of return, your R is basically 12%. And they are asking you the P0. Okay? In the examination, we expect lesser number of numericals and more theoretical questions. But the problem is, from the numerical part, what they will do is, they will convert the numerical or the formula based part into a theoretical question. So be prepared for those kind of things. Okay? Let's talk about the P0 there. When we're talking about the P0, it is actually D1 upon KE minus G. This is a question which I've created from our IIBF book itself. This is basically 3 divided by 12% minus 5%. So in this case, the correct answer will come out to be, correct answer, it is 42.86. It is 42.86. What is the formula? To find the present value of your market price, you have to do D1 upon KE minus G. Or in our book, it is written as R. This is the terminology through which we used to learn. So I still write it like this. In our book, it is written as R minus G. Okay? Next question. We are talking about what the equity shares of the company generate dividend payment of rupee 1. The growth right now is 30%. On the other hand, they will increase it in a recent fashion, matlab linear fashion over the years of 10 years, and then it will level out. Matlab the growth is given G1 and the growth is given G2. Then what is the company's intrinsic worth? You have to find the intrinsic worth of the particular share in such a way that, assuming that investors require a return of 15% on their investment. The following information is given. D1 is given, your GA is given, H is given. This is your Hillier model, everyone. Then your GN is given and R is given. When such a kind of question is given, let me just directly switch to the answer. The formula is this, everyone. In this case, you can do it in any way. It is actually P0 is equal to D0. Your current dividend, if the next year's dividend is given, it is good. If it is not, then you adjust it with the growth and you have plus, we have H. Okay? If we have H in certain case, where we talk about H is the area of your the time period in which you will see the growth over the period of time. So we will take the H and this is divided into half. As you can, this is done. Okay, where it is? Can you see this thing is done over the period of 10 years. So if it is done over the period of 10 years, your H is equal to always half of what your time tenure is. That means in this case, you will consider H as 5. So what you will do is you will take H and you will take GA minus GN and you take R minus G common. That is what they have done. This was your dividend. You took your growth portion, normal one, and then you took your extraordinary growth minus GN and divided by your R minus G. This will give you the answer of 42 rupees. Again, a question which I've taken from the book itself. This particular formula is given in the book. What they can do is, if they won't put the question, what they will do is, they will put this kind of question in a format where you will feel that as if the question seems to be the same. But they are putting this kind of question into the form of a theoretical question. So concept is given, that what is the point of Hilliard model, then they are given how to calculate H has been given in a statement form. So you will have to understand the formulas in order to decipher those questions. Next point is other non-discounted cash flow valuations. This is what is the primary focus of a relative valuation model. Analyzing the cash flow characteristics, estimating the growth rate, then comparing the assets worth or to the prices of comparable assets in the market, or evaluating risk factors. What would be the answer in this case? Relative valuation. Relative means comparing your organization with some other organization. So it is just to find out how much growth can we see. When we talk about the comparability in this area, there is only one particular point which talks about it. It's the point C. I'm sorry. So that is C. Comparing the assets worth of the prices. Relative itself means an organization in which we are comparing two things which are of two different sides. Correct, sir. It is actually 2H. This is how the book describes it. That 2H is equal to 10, and then when you have to find H, you divide it into divided by 2. Next point, assertion reasoning based question. I hope it is visible clearly. Relative valuation models are particularly useful in its challenging to qualify the absolute value of an asset directly. Or the next point is related to the area of relative valuation involves comparing the assets value to the prices of similar assets. We are looking at not the same but similar assets and providing a benchmarking based on the market's perception. Both of them are true. Relative means to compare your organization's value with some other organization which is very similar to yours. Next point, what is the formula to calculate PE multiple? In terms of PE multiple, it is what formula? Whenever you have to learn PE multiple, na, always remember P here means price. It is actually market price share, market price per share, and then earning per share. This is the formula. These kind of questions can be asked in the examination. They can give you a formula kind of thing, and you have to choose which particular formula they're talking about. So in this case, PE ratio is MPS upon EPS. It is B. That everyone? Next question. V and S are looking forward towards the area of equity percentage is 20%, R is 15%, company's dividend payout ratio is 3% and retention is 7%. Achha, the question is incomplete. You have to calculate the PE multiple. Calculate the PE multiple. Again, a question from the book itself. Given in the IIBF book there. This is the formula to be used. In the PE ratio, whatever your retention is, this is B. And 1 minus B is your dividend payout ratio. And you take R below and then you have return on equity multiplied by the portion that you are retaining. Matlab, whatever portion that you are retaining in the organization, you will get interest on it and you remove it from R. So this is your PE multiple. Okay, this is a specific question. In terms of PE multiple, what will you do? You will write the portion that the company is actually paying. So the dividend is here and R minus whatever you are retaining in the business. Done? Then comes, this is the formula. This is for PE ratio. I've given all the formulas in this particular area itself. This is your PE ratio. This is your PB ratio. And this is your PS ratio. These are three ratios, everyone. The first ratio is, that is PE ratio. That is price, that is market price upon the area of equity. Second is price to book value. That means what is the value? I'm sorry. what is the market value in terms of the book value. And the last one is your price to sales ratio. And these ratios are further used in calculating the PEG ratio as well, PEG ratio. Okay. So here comes the next question, everyone. Price to book value multiple is derived from a stock metric, namely book value per share, which is obtained from the balance sheet. Book value per share is calculated as shareholder funds preference is minus from it and number of outstanding share. This kind of question, people will think, man, this kind of question is asked as a theory question, na? No practical is coming. But the point is, if you do not know about the practical portion, you can never find out what this question is trying to say. In this case, the correct answer would be A again. That is true. Achha, I've already marked it. The answer is true. This is the formula for PB multiple, everyone. Price to book value. Then comes the next point. The next question says, what approach involves discounting the anticipated increase in the cash flow attributable to intangible asset? Whenever we are trying to record the value of an intangible asset, then such as brand name back to the present value. That is capital investment approach, discounted cash flow valuation approach, relative valuation approach, or amortization approach. Whenever we are trying to value the intangible assets, it is always done through discounted cash flow valuation. Okay? We are always using this particular method only. Amortization talks about the reduction of its value. Next question was related to the what is the value of an asset proportion to when all the other factors are held constant. Uncertainty of cash flows, level of risk associated with cash flows, the volume of cash flows, their growth rate, and the risk associated with the cash flows or expected growth rate. When we are trying to find out what is the value of the asset proportional to when all other assets factors are held constant. When we are keeping all other factors constant, it is the multiple areas which we are considering. First of all, what is the volume? What is the amount you are getting? Number two, the growth rate. Matlab, if it is growing, at what percentage is it growing? Next comes the value of the risk associated. If the risk is more, definitely in the valuation you will see there is a downfall. If the risk is less, then there is a surplus point. Ki yes, this calculation can be done properly. Then comes real estate investments. This is also an important area to cover. In the real estate investments often have limited lifespans and their value at the terminal stage may be less than the current value because obviously in the beginning the real estate is absolutely new, the value is more and slowly and steadily its value declines. The terminal value of the building may decrease as it is used, but the land component having an endless life can be significant factor in determining the final value. Achha, the answer is already marked there when we talk about this area. I think in the reasoning and assertion, one particular thing that I'll be keeping in mind is we'll be putting more of a different areas. Okay, then comes the area of mergers and acquisitions, a topic which has multiple things to cover. Here comes the question, what is a relative valuation approach in estimating the value of intangible assets? Relative valuation approach in terms of estimating the value of what they do is relative valuation approach simply says you compare your organization with some organization which is very similar to yours. The comparing point is written in only point B. So in this case the correct answer is point B. Okay? The answer is point B there. Now comes the next point, which one, what is that one approach to estimating the value of intangible assets such as brand names? Market comparison method, capital investment method, then we have revenue discount method, or the last one as barter system. There is nothing called barter system. When you are trying to find the brand names and all, it is always the capital investment method. Okay? When you are trying to find the value of a capital investment that you have made. Then what characterizes the congeneric merger? There are different types of mergers there. Congeneric, conglomerate, right? And then we have vertical and horizontal. There are 4 types of it. Then merging companies produce similar products. Merging companies operate in the same market sector. Merging companies have no fundamental connections, or the goal is to avoid the lengthy IPO process. when we are trying into congeneric now, you are trying to get into an organization which is basically very similar to yours. Conglomerate is the one which is different from yours. Vertical integration is basically you buying your supplier or someone who's basically in the chain logistics. It is just below you. And when we talk about horizontal, a company which is at your level and in the same industry, when you have that kind of thing, that is called horizontal. That means you are buying your competitor. Okay, these are covered under this area. Next question that covers a reverse merger. What do you mean by reverse merger? One particular company, a larger public listed company acquiring a smaller unlisted company, and then a smaller unlisted company acquiring a large publicly listed company. The focus is on expanding the debt capacity or merging companies having a buyer-seller relationship. When we talk about reverse merger, now mergers happen when one particular organization is trying to get into some other organization. The point is this organization had been trying to get into SEBI listing and then getting into the private equity and public equity where public can invest in, but they just cannot make it. So what they do is, if we cannot make it now, then what will we do? They said, okay, if it's fine. If we cannot make it, let's buy an organization which already has an access in the public companies. So if it has an access of public company, then in this case, what would be the answer? It would be a smaller unlisted company. People haven't thought that this unlisted company can get into that area. So this unlisted company acquires a larger publicly listed company. I'm sorry. Correct answer, everyone? A smaller unlisted company acquires a larger publicly listed company. That's the answer. Then what involves a slump sale? Slump sale, what do you mean by slump sale, everyone? It involves a specific valuation for each asset category. Shareholding structure changes significantly. Capital gains from some slump sales are subjected to income and income tax. And then it is completed for a single sum of money without any specific valuation. Slump sale is a kind of sale which is done by selling the entire business together. That means all the assets and all the liabilities are valued and clubbed together, and then we are giving it to someone. So technically, yes, it is something where we have a single sum of money without any specific valuations. I am saying that the value of the entire firm would be this. According to me, this should be given. And even there's one more thing that is correct. The slump sales in India are subjected to tax as well. Capital gains is applicable on it. So there are 2 points which are correct about this. In the purchase of division or a plant, when we are trying to purchase a specific area, the acquiring company takes over all the assets and liabilities. The acquiring company pays compensation only. A fraction of the assets and liabilities is taken over, or the selling company continues to operate independently. What will happen in this case, everyone? In purchase of any division or plant, when you're trying to do this now, when you are just buying a part of it, you're not buying the entire part. So in this case, the correct answer is a fraction of assets and liabilities are to be taken over, not the entire portion. Then what is the characteristic of leveraged buyout? Leveraged buyout is basically when you are buying some organization but you don't have money. So what will you do? You will use your money and buy it for yourself. Matlab, what I'll do is I'll take a loan from certain persons and then I'll utilize it to buy the competitive firm that I wanted to. So that is covered here. It is accomplished without any loan financing. It involves a transfer of assets and liability obligations, and it typically involves loan financing, or it is the same as a divestiture. So in this case, divestiture, in this case, the correct answer would be C. It is typically involves loan financing. But for what reason? To buy or acquire competing firms. You can say competing firms or the firms which we are obsessed with. This is what I want in my life. That particular firm that you want to buy. Okay, so I think this would be the last question, everyone. The PDF of this particular class would be shared along with you on the particular on my area of my channel there on the Telegram channel, I'll put the PDF of this class as well. So please review the same. Now, what does the PSU disinvestment involve? PSU is public sector undertaking. There were many public sector undertakings which now have been called for. Now they are not continuing anymore. The strategic investor or a public buying a portion of the parent company, the sale of business division to another company, the transfer of ownership between two companies or demerger of a business division. Public sector undertaking disinvestment means this public sector undertaking is now basically a strategic investing where the public buying a portion of the parent company. That means a PSU is now getting over and normal public can buy a part of it. So that is what they do. Many PSUs had turned sick or they were loss-making companies by the time globalization, liberalization and privatization came in our country. So due to the LPG policy, it later came into the well-being, into the particular area. So when we talked about that area, it developed just because of this reason. So basically PSUs had gone through a lot of losses. So ultimately to dispose of, this is what they did. Chaliye, I think this is where I would end my specific session for the entire area. It is just basically a turnout, or I can say an extended portion of the modules that we were discussing yesterday. The same would be put on my, I'll be putting it on my Telegram channel, that is CAIIB Exam 2023 Niharika ma'am. That's my name. So you can find this particular channel. All the particular questions from the marathon has been put there, along with many of my mini marathons have been there. So if you're looking forward towards these questions, kindly go ahead and check it out on this particular Telegram channel. You will be able to find it there. All the very best for your examination. Be very sorted, be very clear in your examination. Along with that, decode the questions. The language is never going to be easy tomorrow. But there's one particular thing that I can say, the language can be typical tomorrow, but the concept would be easier. So what you need to know is what exactly the question is asking. Read it time and again, go through it so that you are not going wrong in the particular area at all. As you have seen in many questions, the concept is just as much. It's just the play in the language. So we should be very sorted about the play in the language that they can do. So the more clear you are, the better it would be. So that's it for the day, everyone. I'll be meeting you in the next class, that is on the day of analysis. That is, we'll be conducting the analysis tomorrow. For the first shift, we'll be meeting at 10:30 for English medium and 5 p.m. again. So kindly be there. I'll be waiting for you. Thank you so much, everyone, and all the very best.